What's up, guys? Welcome back to the SKGS Incorporated YouTube channel. As you know, I'm your host SK, and we are back here with the FinLit series. So guys, as you know, we're doing season 1 of the FinLit series, right? And this is going to be episode 3. So guys, what we're going to go into on this episode 3 is going to be 3 specific topics. Topic 1, guys, is going to be what is a candlestick? As I'm sure you guys have seen that whenever traders trade on a trading chart, they normally use something called candlesticks. So we're going to explain to you what a candlestick is and how it works. So number 2 is going to be what are the 4 different types of trading sessions. So guys, there are 4 different trading sessions that occur during the day, and each trading session has different volatility that occurs within that trading session. So we're going to be explaining to you what those 4 trading sessions are. And then number 3 and lastly, guys, we're going to be talking about what are time frames when it comes to trading and how do you navigate different time frames on a trading chart. Topic 1. Okay, so guys, topic 1, what is a candlestick? A candlestick is an instrument which is represented on a trading chart, which shows you if there are buyers in the market or there are sellers in the market. A candlestick shows specific price movements that occur during the day. So for example, guys, we have green candlesticks and we have red candlesticks. Then green candlesticks, which are for buying, have a different close and an open of the candle. And then red candlesticks, which are for selling, have a different close and open of the candle.
Okay, so guys, this is what a candlestick looks like. It's normally referred to as a Japanese candlestick, and this can be found on your trading charts, but we're going to show you what it looks like on your trading charts later. But for example, we have a green candlestick here on the left, which is a buying candlestick, which indicates buyers in the trading market. And then we have a red candlestick here on the right, which is for selling, which indicates that there are sellers in the market. So as you can see, guys, this is an explanation of how a candlestick works. So a green candlestick, which is for buying, opens at the bottom and then closes at the top. And then we have these things here, which are called wicks here. So that's basically how a green candlestick, which is for buying, works. And then a red candlestick, which is for selling, opens at the top and closes at the bottom. And then we have these things, which are wicks. So guys, as you can see, we have green candles, which are for buying, which means that buyers were in the market at this point in time. And then we have red candles for selling, which means that sellers took over and then there were sellers in the market. So we have green candles and red candles again. So these in-between candles, for example here, since there are more green candles than there are red, it means that buyers were in control. But these little candles show that sellers tried to get into the market but weren't strong enough to actually beat the buyers. And as you can see also over here, this is a seller's market. So there's more red candles than there are green candles. But there are a few green candles, which shows that buyers tried to get back into the market, but they didn't have enough strength to beat the sellers, guys. So guys, that's basically how candlesticks work.
Okay, so guys, now we are on topic 2. So topic 2 is the different trading sessions which occur during the day. Okay, so guys, there are 4 different trading sessions that occur in a trading day. Number 1 is the Asian trading session. Number 2 is the London trading session. Number 3 is the New York trading session. And number 4 and lastly is the Sydney or Australian trading session. So guys, we're going to go more into detail about how those trading sessions work and how to use them when you're in South Africa. So guys, we're going to just show you a couple of examples of how that would work.
Okay, so guys, now that we are on topic 2, which is the 4 different trading sessions that occur during the day. Okay, so guys, as I said before, there are 4 different trading sessions which occur during the day, which is number 1, the Tokyo or Asian trading session. Number 2, the London session. Number 3, the New York trading session. And number 4 and lastly, the Sydney or Australian trading session. Okay, so guys, I'm going to make this example for South African traders. If you're a South African trader, guys, this is how it would work for you. So the Tokyo or Asian trading session starts at about 1 a.m. in the morning and then ends at about 8 a.m. in the morning. And then that's when the London trading session starts. The London trading session starts from 8 a.m. in the morning and then ends at about 3 p.m. in the afternoon. And then after that, the London trading session, we go into the New York trading session. The New York trading session starts at 3 p.m. in the afternoon and then ends at about 9 p.m. at night. And then after the New York trading session, we go into the last trading session, which is the Sydney Australian trading session, which starts at about 9 p.m. at night and then ends at about 12 a.m. in the morning, midnight, I would say. So guys, that's how the 4 different trading sessions work. And as I said, guys, each trading session has its own type of volatility in the markets. So the markets will move differently depending on which trading session that you are actually trading.
Okay, so guys, now that we are at the end of the video, we are going to be talking about topic 3, which is what are trading timeframes and how to use them and how they actually work. So guys, we're going to be showing you a couple of examples of trading time frames.
Okay guys, so now we are on topic 3, which is the last topic of this episode. So we're going to be talking about trading time frames. When it comes to time frames, guys, there are many different time frames. As you can see, guys, we have the monthly time frame, the weekly time frame, the daily time frame, the hourly time frames, and we have the minute based time frames. So guys, we're going to go to the highest time frame just to show you an example of each. So we're going to go to the monthly chart. If you press the monthly chart, it'll show you the trading instruments which you're trading, how it looks on the monthly chart. So for explanational purposes, we are using NASDAQ in this video, guys, as you know. So this is how the monthly chart looks. As you can see, the candlesticks are bigger on the monthly chart because each candlestick represents 1 month of trading movement. And then we're going to go down to the weekly time frame, guys. So now this is the weekly time frame. As you can see, guys, the weekly time frame, it's a more zoomed in analysis of the monthly time frame. As you can see, there are more candlesticks because there are more weeks within a month, and each candlestick represents 1 week. Okay, so guys, now we're going to go down to the daily time frame. As you can see, the daily time frame is different compared to the weekly time frame. As you can see, there are more candlesticks in the daily time frame because, as you know, each candlestick is going to represent 1 day. And as we know, since in a trading markets open from Monday to Friday, so each of these candlesticks are representative of Monday to Friday. As you know that there are 5 trading days within a week of trading. Okay, so guys, now we're going to go down to the 4-hour time frame. As you can see, the 4-hour time frame has more candlesticks, even more candlesticks, because each candlestick represents 4 hours within that trading day. So each candlestick is representative of 1 day's worth of trading, but in 4-hour increments. So each candle is equal to 4 hours of candlestick movements. And then we're going to go lower, guys. We're going to go to the 1-hour time frame. As you can see, the 1-hour time frame also has more candlesticks than the 4-hour time frame because each candlestick is representative of 1 hour of trading movement. And then we're going to go down to the 30-minute time frame. As you can see, the 30-minute time frame has even more candlesticks than the 1-hour time frame because in the 30-minute time frame, each candlestick represents 30 minutes of candlestick movements. And then we're going to go down to the 15-minute time frame. As you can see, there are even more candlesticks now because each candlestick represents 15 minutes of movement within that trading day. And then we're going to go down to the 5-minute time frame. As you can see, in the 5-minute time frame, there are even more candlesticks. So as you can see, each candlestick represents 5 minutes of movement within 1 trading day. And then the lowest time frame we can use, which is the 1-minute time frame, has the most candlesticks because each candlestick represents 1 minute of trading within a trading day. Okay, so guys, I don't know if you've noticed, but this is how candlestick time frames work. The lower the candlestick, the more candlestick it shows, which is almost a zoom in of a bigger candlestick. And the higher the time frame, the less amounts of candlesticks there are, because it's almost a zooming out of a candlestick chart. Okay, so guys, that's the end of this topic.
Alright, so now that brings us to the end of our video for today, episode 3 of season 1, the FinLit series. Hopefully you were able to gain some value from this episode, and subscribe, like, comment, and share the content if you enjoyed it. See you on the next video.